Hi there, welcome to Kneppy Invest. Time to do one of my favorite types of videos, a technical update. And in today's technical update video, I'm going to be focusing on 5 ASX stocks and 3 stocks on either the New York Stock Exchange or the Nasdaq. And I am starting to put more and more tech stocks onto my buy or to buy watch list because some of the valuations of these companies are getting down to 5-year lows. And they do look really interesting. And the sell-off we have seen, particularly among tech stocks, is opening up opportunities. Now, it doesn't mean we have seen the end of the sell-off. We still might have a few more down months, particularly with the perception that economies around the world will struggle to grow over the next few months. And I won't say the word recession, well, I just said it then, but there is that potential we might be heading into a recession. And if we do go into a recession, that would be the ideal time to buy. When these companies are experiencing their worst times, you will see valuations of these companies become really attractive. So that's what I'm thinking right now, and why my to buy watch list is starting to grow quite considerably. And most of those companies are actually American tech stocks. So what are the 8 companies I'll be featuring in today's video? The Australian companies I'll be featuring, many of these actually I have not looked at in the past. Zip, Dusk, ANZ and NAB, and also Viva Energy Australia. I have mentioned Zip and Dusk quite a bit of times. Don't usually talk about banks, but we do see something significantly different between NAB and ANZ when we look at their charts. And also Viva, one of the only companies on the ASX that is in an uptrend right now. And they are experiencing some significant tailwinds behind that business. That does not mean it's a buy or long-term buy, but definitely a possible short to medium-term buy. And the 3 American companies I'm going to be looking at are Shopify, Unity Software, and Zoom. I'll talk about why I'm interested in these 3 companies when we look at their chart. First company I want to look at is NAB, National Australia Bank. And in the next slide, we'll have a look at ANZ. So I just want you to remember NAB chart as we compare it to ANZ in the next slide, because they are actually quite different. And this goes back to the bottom of the COVID-19 financial panic, which was around about March 23rd of 2020. So this is over 2 years of charting here. And the share price of NAB got down to as low as about almost $13. And right now the share price is above 30. So that would have been a great time to buy NAB. Now, with rising interest rates, NAB or the banks should be experiencing some tailwind. So that's why I think right now NAB's share price is in an uptrend. But in saying that, and the reason why it is a tailwinds for the companies is just because their margins or the interest margins do increase during those periods. So even though banks should be experiencing some tailwinds, if we do move into a recession or something even worse, there's going to be a lot of loan defaults, and that is actually bad news for banks. So I can see this going quite a few different ways for the banks. But right now, NAB is one of the companies you might be thinking about taking a position in, just simply because the share price is in a nice little uptrend. It is probably the most favored banks right now among the experts, the fund managers. I have actually listened to quite a few podcasts who talk about NAB as the better quality bank if you discard Commonwealth Bank of Australia, because typically that is the most favored banks among the big 4. And the next company you'll be looking at in the next chart, ANZ, is typically put last in the rankings of the 4 big banks. It's a big turnaround for NAB, because quite a few years ago, this was considered the worst of the big 4. And maybe this excitement among fund managers and the experts is a reason why NAB is in a really good uptrend right now. Well-defined uptrend ever since about November of 2020. Now onto an ANZ bank, and just like NAB Bank, this goes back to around about the COVID-19 period, and ANZ share price got down as low as $14. So almost the same as NAB. But you can see from about the bottom of the COVID-19 financial panic all the way through to about March 2021, ANZ Bank and NAB's bank chart looks fairly similar. But then something happened around about March 2021 when the excitement for ANZ just fell away. And that was the peak in the share price. In fact, there was a triple top at around about $29.50. We saw that level reached about 3 times, March, May, and then also in July. And usually triple tops are bad news, so natural resistance level at that point in time. And unlike NAB's chart, which is in a well-defined uptrend, the share price, ANZ is actually the complete opposite. We are seeing ANZ share price actually drift lower. And again, one of the reasons behind that is this is the least favorite bank or big bank right now among those big four, so which is ANZ, Commonwealth, NAB, and what's the other one? Westpac. And this is by far the worst looking chart for or among those big four banks. And the share price now is, if you just take away the low we saw a few months ago, the share price of ANZ is almost at a 1-year low. Now onto Zip, and just like the two banks, the chart for Zip goes all the way back to just prior to the COVID-19 financial panic. And the low during the panic was $1 for Zip. And then from the low, March 2020, all the way through to about March 2021, buy now, pay later was the fad thing to buy into. You can see with Zip's share price, it went from $1 to a high of $14 reached in February of 2021. So that was the peak in buy now, pay later. And ever since that peak, the sentiment in that sector, buy now, pay later, has really come off. And to be honest with you, the sentiment in buy now, pay later right now is absolutely horrible. And that's one of the reasons why Zip share price has fallen from that high of $14 all the way now to less than $1. Yes, Zip share price is now less than what it was during the COVID-19 financial panic, and it just keeps on dropping. There's no end in sight to Zip's share price drop. And I think there's two reasons behind that. The first reason is this company and the other buy now, pay later companies' share prices have been caught up in the overall tech sell-off. And the other thing is just that sentiment in buy now, pay later. If Zip ever becomes profitable, it's going to be a long time in the future, and more than likely. But the best thing that Zip's management can do is try to reach profitability as soon as possible, particularly with the share price falling and falling and falling. I'd probably say the market cap of this company is now less or near $500 million right now. And if it keeps on dropping, the access to capital will become harder and more expensive. So when the share price was $14, market cap really massive, the access to capital then would have been quite easy and it would have been much cheaper. So management of this company have to be careful with the share price falling. They have to be or try to get to profitability as quick as possible to correct that situation. And if they do become profitable, we might see a shift in sentiment for this company. I'm a little bit dubious about that just because the sentiment in this sector is really horrible right now, and it will take a lot to shift that sentiment. Now onto a company, Dusk, that I have featured before in videos, and this was a holding I did have, not a long-term holding, but I took a position in Dusk way back in December 2020 when they did release a profit upgrade. I bought in at $1.98. A few months after they did list on the ASX, I went against some of my rules. I prefer to wait at least 6 months before I take a position in IPO. But Dusk released that profit upgrade, and that was enough for me to take a position. And then over the next 6 to 7 months, the share price went on a nice run, increasing, almost doubling, actually more than doubled, because I bought in $1.98 and the share price reached a high of $4.05 in July of 2021. And then overall sentiment in retail started to shift around that time. That's why we started to see Dusk share price really struggle. And you can just see how the share price moved up during the first half of 2021 and started to move down from there. So there was an overall shift in sentiment, not only in Dusk, but also the majority of retail stores. Not all of them, quite a few have held on quite strongly. Maybe not strongly, strongly is not the best word, but they have held firm and really haven't gone through a major correction in the share price. But Dusk share price has fallen from that high of $4.05 and is now heading back towards the price I bought in December 2020, and that was $1.98. If it falls through about $2, that would be a bearish signal. But I always thought, even when share price of this company reached about $4, there was still good value in this company. But you can just see how the market can affect the share price if it turns negative, even if there is some good value there. So what I'm going to do with Dusk, I have put it onto my to buy watch list, and there's no reason to buy in right now simply because the share price keeps on falling. And I think maybe the best time to buy not only Dusk but other retail companies is at maximum pessimism. And maximum pessimism would be when we're in a recession, and that is the best time to buy companies when we're in the recession, not before, but when we're in, and not after that either, because that's when you usually see the best value. Now, even though the last two companies I featured in this video have seen the share price drop a lot over the past year, not all companies are seeing their share price in a downtrend. Some companies are benefiting from where we find ourselves in the world right now. And Viva Energy Australia is one of those companies. They sell fuel, petroleum or petrol to Shell Australia. So you just imagine some of their margins are really good right now. And that's why the share price of this company is in a well-defined uptrend and has reached at least a 2-year high. So just like the other companies in this video, share price of Viva Energy Australia goes all the way back just around about the COVID-19 financial panic. Share price of Viva Energy got down to about $1.40, and right now it's $2.90. So nice positive sentiment in Viva Energy Australia right now. Oil prices remaining high should be beneficial for Viva Energy, and that's why the market is really liking this company right now. Now to the three American companies, and the first one I'm going to look at is Shopify. There's actually two reasons why I've included Shopify in this list. I really haven't really thought about this company in the past. They are an online retail company or something like that. But the first reason I've included Shopify in this video is simply because I've heard the name Shopify about 5 million times in the past few weeks. Now, of course, I'm exaggerating when I say 5 million times, but it seems like every single time I listen to an American-based podcast or investing podcast, I just hear the name Shopify. So I thought I'd have a look at the chart, and the chart right now is absolutely horrible for this company. The share price has absolutely fallen off a cliff over the past 6 months. In fact, the share price of this company reached a high of $1,700.60 in November, and right now is around $320. The second reason I wanted to include Shopify in this video is simply because when you compare the share price right now to the COVID-19 lows, they're very similar. So back in March of 2020, the share price of Shopify fell to $320, and right now it's $320. So that means the sentiment for this company is actually worse than it was during the COVID-19 financial panic, when everyone was panicking and the majority of company share price were sold off. And that does mystify me, because this company is significantly bigger than it was back then. That was 2 years ago. And I think the market got too excited about this company because online retail is going to grow in the future. And I think the market was extrapolating the growth during COVID-19. I thought that was going to continue forever. And then recently we've seen, well, that's not true. And that's why Shopify's share price has been sold off. Plus overall negative sentiment in tech, that's another reason. So Shopify, I did actually have a look at their financial state. It actually does look interesting. This company is growing at a really quick rate. They are generating cash. So I think Shopify is looking really interesting right now. So I've got to say thank you to all those podcasts who actually did put Shopify onto my watch list. The second American company I want to talk about is Unity Software. Now, this company has been on my watch list for a while. The one reason it's been on my watch list is just what they do, an immense or potentially immense field of growth or area of growth. They're into gaming and virtual reality, that sort of thing. And you can just imagine, because they are tech, they're not profitable. And that's the main thing here. A lot of non-profitable tech companies have seen their share prices absolutely slashed, even trashed, and Unity Software is right among them. Now, this company listed on the Nasdaq or the New York Stock Exchange, more likely the Nasdaq, back in September of 2020. And the share price actually reached a high of $210 in November of last year. And that does seem to be at a time when a lot of tech stocks did reach their peak. And you can just see prior to that peak, the share price of Unity Software just started to rise exponentially. And anytime I see a share price rising exponentially, I get nervous. I'm not really nervous, but I do become a little bit more wary because usually, I'd say the vast majority of cases when share price does rise exponentially, there will be a sell-off. And that's exactly what's happened to Unity Software. Share price has dropped from $210 all the way to a low of $30. There was a really good support level at $75, which was a low we saw back in May 2020. So I put that line there. The share price reached $75 in March of this year, and then we saw a bit of a bounce, a bit of a relief rally, maybe a dead cat bounce. Share price went from $75 to $110. So that support level held firm. So really good support level there. But it only took 1 month later before the share price zoomed lower than that support level of $75. And as soon as it fell below that, a lot of selling came in, and that selling drove Unity share price from $75 all the way down to $30. So because of the immense potential growth in this sector, in this company, that's the main reason I'm interested in Unity Software. They are not profitable, but their revenue is growing at a fantastic rate, just like a lot of other tech stocks. But it's all about profitability and the ability to generate cash in their business. And the question for Unity is, will they be able to do that before anything worse happens to this company? So I think as these companies' share price drop and drop, access to capital, I've already mentioned this, access to capital becomes harder, and also capital becomes more expensive. So you've got to take advantage of times when the share price is really, really high. Like when the share price got to $210, that would have been the ideal time to do a capital raising. But as the share price drops and drops, capital becomes harder to find, becomes more expensive. And that's why a lot of these non-profitable tech companies have to try to get to the profitable stage, the cash flow generating stage. And if they do that, that's how you fund your growth. You don't have to rely on the capital market. Now, Unity Software might be unprofitable and might be burning through a lot of cash. Maybe not burning through a lot of cash, but definitely highly unprofitable. Zoom Communications does not have that problem. This is one of the most fascinating stories, I think, in the investing world right now, because you can see the sentiment in this company shift on a dime in October of 2020. And why did it shift on a dime? All because of vaccines. Now, this is a company that really benefited from lockdowns and COVID-19. In fact, you can't even see the COVID-19 financial panic. Share price of Zoom actually kept on rising during that period, which makes sense. But if we go back to prior to the COVID-19 financial panic, share price of this company was around $70 or just below $80. Share price went from that level all the way to a high of $580, almost $600 in a very short period of time. And of course, as soon as the vaccine news came out in October 2020, that's when we saw the peak in Zoom share price. So all those people who were bullish on Zoom thought, well, good times have come to a stop. And that's what has driven, that shift in sentiment has driven the share price of Zoom down from $580 all the way to just above $80 right now. But even though this company did benefit from COVID-19, it's not only about COVID-19. This company is in it for the long haul. And the current market cap of Zoom is $30 billion. Yet they just released their quarterly results. This company generated $500 million in cash flow. I think it was $550 million in operating cash flow, $450 million in free cash flow in 1 quarter. So if you extrapolate for the whole year, that's about $2 billion in cash flow for a company with a market cap of $30 billion. That does seem like potentially good value. Now, you might compare the quarterly results to last quarter, and there hasn't been much growth in there, but the company hasn't declined. And the market did get excited about the quarter results. And even though the overall market fell, this was on the 24th of May, even though the overall market, or Nasdaq, fell by a fair bit that day, Zoom share price actually rose about 5%. And then the next day, Zoom share price rose another 8% on the back of quarter results. So the financial state of this company looks really sound, really good. And there is a lot of potential growth ahead for this company. This is not only a COVID-19 story, this is a long term story. So that's the main reason I have put Zoom communications on the top of my potential buy list, particularly because of those quarter results. The only thing holding me back is just this negative sentiment in the tech sector and even in Zoom communications right now. The share price is still in a downtrend, and I need to see some signs that sentiment is shifting. The last 2 trading days look hopeful, but we need more signs. We need more confirmation that the bad times for this company have come. Well, bad times for the share price in this company have come to an end. That's all I have for this technical update for 5 ASX companies and 3 companies based in the United States. Those companies are Shopify, Zoom, and Unity. If you have any questions about any company I featured in this video, if you have differing thoughts than I'd love to hear different thoughts, because that's how we learn to grow as investors, even as human beings, to be able to see the opposite viewpoint, and not only see the opposite viewpoint, but take it on board. And maybe we can change our minds about a company or an idea by being open-minded. One of the biggest problems in the world right now is the amount of people out there who are closed-minded about their opinions changing. Anyway, if you have any questions about any of the companies I've featured in this video or any thoughts, just leave in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.